Hello, let's review Company One's result for year one. First, we're going to talk about generals of the company, then we're going to go into the strategy, the commercial results, the profitability, the cash flow, and finally, the recommendations. Company One is a company that manufactures three types of boats, Petch 4, Prom 5.5, and Stan 8. Petch 4 is the simplest boat, and it is used for non-professional fishing, while Prom 5.5 it is more of a specialized boat and it is used for trips on the sea, on the lake, on the river, and even on the canal. Besides, it can be easily transported. It was designed for longer trips and it is equipped with a cabin for two people and a basic kitchen. Lastly, Stan 8 is exclusively destined for trips on the sea and on the lake. There are two raw materials needed, plastic and wood, and three different suppliers available for each of this. Based on this information, Company One created a strategy to increase their sales and become more profitable, which we're going to talk next. Now, let's talk about the strategy. In terms of strategy, it's important for this company as any other to have a specific strategy, or in other words, a long-term planning and operating method to achieve determined objectives. Company One, to create the strategy, considered four factors: pricing, suppliers, product, and forecast. Pricing is extremely important when it comes to a business strategy, since it plays a crucial role in determining the company's revenue, also the market share, and profitability. Company One decided to study the minimum, the normal, and the maximum prices that are being paid for these boats on the market, and based on that, they set their own prices. Along with this decision of setting the prices based on the value customers were willing to pay, the company also compared the prices with the competition. And although it was known that the other companies sold their boats on a lower price, they also advertised different factors, being one of them pricing. On the other side, Company One advertised resistance and comfort. Now, moving forward with suppliers. In terms of suppliers, there are three different suppliers available for each of the raw material types, plastic and wood. Each of the supplier managed different prices and different credit granted months, and prices are higher as the credits are also higher. But the company strategy and the decision that they took was to use all suppliers, depending on the demand and the materials needed. Usually, when the quantities needed of the raw materials were low for a specific month to satisfy the production objectives, the suppliers used were the ones with a lower price, but whose payment method was to have credit. The opposite occurred when the requirements were high. The decision in these cases was to buy from suppliers that granted a payment period about 2 or maybe 3 months, although the prices were a little bit higher. Now, related to the products, the decision of Company One was to produce all three types of boats, but always depending on the demand. Last but not least, understanding the forecast, it is very important for any business to be able to make informed decisions. Every month, Company One set the objectives in terms of sales for the month for which the forecast was studied. The information of future as well as historical forecasts allow the business to set achievable goals. The visibility not only of the forecast but also of the seasonality help the company make strategic decisions in terms of how the operations were managed and how much to produce each month. This includes also decisions around pricing, advertisement, human resources, the machines, the raw materials, etc. Each month, Company One decided the objectives based on the demand adjusted by the seasonal coefficients. The decision was to set goals that were close to reality of the forecast, but in terms of production, the decision was to produce always a little bit more just to avoid stockouts and for the competition to take advantage of this. Now, let's talk about the commercial results, and let's start with sales. Sales are the key in any company since it generates revenue. Without sales, there would be no income and the company would not have the possibility to generate a service or a product and to maintain the operations of the company. Throughout year one, as you see in the picture, 987 boats were sold by Company One, 324 boats under the leading company in the market. Out of these boats that were sold by Company One, 348 votes correspond to Page 4, 532 to Prom 5.5, and 107 to Stand 8. In hand with this, the sales turnover evolution was also analyzed. Sales turnover highlights the company's total amount of boats sold during a specific period, and it represents how much revenue a company was able to generate. There was a higher revenue on the months of April to August and a significant decrease in October and November. The cumulative sales turnover was around 14,700,000 in year one. Lastly, when studying the market share in value, although in terms of sale the company one just reached 28%, in terms of value it reached 32%, being the second company to lead the market. These results are due to the fact that although company one had the less sales, it had the higher selling price, meaning that the product sold relied on a higher margin. Now, let's talk about profitability. Profitability is a measure of how efficient a company transforms the expenses into profits, since without them, any business will stop. Income is money generated from activities of the business, and in this case, specifically due to sales of boats. And expenses would be everything that does not generate cash for the company, such as, for example, salaries, advertisement, payments, raw materials, etc. For company one, the results before tax, the sales results, the profitability rate, the shareholders' equity, and the rate of return was measured and controlled every month. Starting with the results before tax, this refers to the profits that the company has before paying corporate income tax, while the sales turnover is the income due to sales. During the months of April, June, and August, we can observe an increase in the result of before tax, and related to the sales turnover, the peak was from April to August. The difference in months where it is seen a higher sales turnover, but that is not being reflected on the result before tax, could be due to the increase of raw materials payment, salaries, or even advertisements. On the other hand, the profitable rate shows that the company generated the most profits during the months of April, June, and August. Finally, the rate of a return, which is the net gain or loss of investment over a specific period, showed a positive outcome, except for January. At the beginning of the year, it was reported that Company 1 made a mistake and they misplaced the requirements of the raw materials, confusing the wood and the plastic orders, and this could have caused a financial impact. Moving over to cash flow refers to the net balance of cash moving into and out of a business in a specific point in time. Cash flow can be either positive or negative. Positive cash flow means that the company has more money moving in than out, and negative cash flow indicates that a company has more money moving out than in. Company 1, although initially it showed a negative cash flow, by the end of the whole year, the final cash flow corresponds around to 4,600,000 years. As part of the recommendations, we're going to talk about payment periods, customer satisfaction, and remuneration. Let's start with payment periods. Retailers appreciate longer payment periods, meaning that they're more willing to buy a product if they're given, for example, a 2 or 3 month period to pay. It was known by Company 1 that the competition managed a 3 month payment period for all boats, but still, the decision of Company 1 in most of the months was to pay in cash. This might have led to a decrease in sales for this company and an increase for the competition. It is recommended just to have more flexibility in terms of payments to attract more clients. Now, moving to customer satisfaction. In a real-life scenario, the customer satisfaction metrics are key measures to understand how happy customers are with a product and if they will be willing to buy it again or to even recommend it. This later translates into brand image, revenue, and customer loyalty. Behind these measures hides a very important feedback that can be used to identify new opportunities and to improve the actual service or the product. For Company 1, the customer satisfaction was always below 50%, which was not good. If this was reflected on a current, for example, existing company, it would be suggested to study these measures on a deeper level to understand the why to customers' unsatisfaction. And although negative feedback is never nice to receive, it is also key into understanding the experience of the clients. Finally, in terms of remuneration, it is known that remuneration is very important, and studies also have proven that there is a direct relationship with the happiness and productivity of any employee. Also, specifically for company one, the skills and motivation of the people working in the company depended on the remuneration that was composed first of a fixed salary and also the commissions. It is recommended in general to review the salaries of this company in every department and evaluate if the salaries offered are competitive in the market and reflect a good opportunity for all the employees.